Hi everyone, today is Jsmr. So they had minus 45% sales growth in the first quarter, the 7th consecutive quarter of negative sales growth. But that's because, if we look at the details, that's because the construction, which has been included in sales, has declined enormously. So if you look at the real operating, then that's still growing, about 9% in the first quarter, although it's slowed down a little bit, perhaps not surprising. So you can see what's happening with the construction spending. So we assume that sales recovers a little bit, and 4% growth in the next 12 months. The cash flow, the total free cash flow in the last 6 years is minus 44. It's actually minus 60 something without working capital. There's a big investment in the first quarter, so the last 12 months is minus 20, but we see, excluding the working capital, that the cash flow is starting to improve a bit, and we've cut down the investment spending enormously for this year, which we assume they will do, and we actually end up with some positive free cash flow over the next 12 months, 854 billion. There's a lot of debt because of all the negative cash flow. There's a big jump because of that investment in the first quarter from 33 to 45. There will be a little bit of an improvement in the debt because of the positive cash flow in the next 12 months. They're going to pay out a tiny dividend. It would be better if they didn't pay any in July, I think. Because we've got the real operating business emerging, you can see that the margin is improving quite a lot. So this is what's been happening. You can see the cost ratio has been coming up, and if we look at it from the cash flow, it's even better than that. So we're going to use the latest first quarter, which is 87%, and we get quite a big profit growth, 49%, over the next 12 months with that. So the free cash flow 854 from much lower investment, using our 1.6%. We only putting a 10% discount, so normally with companies with a lot of debt like this it would be much bigger, but just look at the ratio of market cap to asset. It's very, very cheap, and as the real operating company is now emerging, we give it a pretty small discount, which gives a much higher target price of 6,600.